It is said by the Federal Reserve that we're looking at being in the 2022. We're going to have 3 interest rate hikes.
Yeah, so that's another thing that's weighing on investors and markets is this thought that the Fed's going to come out and raise interest rates this year, and that's how's that going to affect stocks and bonds and all that, my money, right?
Right.
So.
And they're doing that to head off inflation, which is at 40-plus year highs.
Mm-hmm.
And now, since this is, I don't, in my personal opinion, I don't think they're going to stray away from these interest rate hikes. However, they may be delayed slightly because since this was produced, we're in the middle of the Russia-Ukraine.
Well, we get inflation from different ways,
Mm-hmm.
and the inflation numbers that the government puts out doesn't always include, for example, like the price of gas,
Correct.
Or the
Correct.
price of. But it's a good indicator of what's happening, and it's past looking really a lot of times.
Right.
But like gasoline is due to this Russian-Ukraine conflict. That's where a lot of the world gets fuel from, and we're seeing prices at the pump and also prices in industry for fuel go up, and that's a form of inflation, right?
Yes,
and
it
that's
is. Yes,
and
it is.
that gets passed on to the consumer. Businesses usually don't keep their prices the same because if you don't make a profit, you usually go out of business, right?
Yes, exactly.
So they're passing that on. That's inflation to us. So it's kind of happening without the interest rate hikes quite as much, but it's still, inflation's pretty high. There's a lot of money out there being put to use, and it may be appropriate for the Fed to act, but I think you're right. I think that they're going to take a second look at that decision.
Right, as we go forward. And we'll reference the inflation a little bit more here in a few minutes, but as we go forward, and just wanting to make sure we touch on several things. How much the Fed raises rates is key, and that is another question. A lot of individuals, or in the past, they were dropping it by 25 bips or 0.25 of 1% or 50 basis points. And this slide just simply, they'll do it in 25 basis points increments. So it's either 25 bips or 50 bips or 75 bips or 1%. Now, I don't think we're going to see a 1%. I don't think that's being talked about. What's been floated around is a 50 bip increase. But the main thing they've kind of committed to is 3 interest rate times during the year that they're going to increase interest rates. Now, what we don't know is how much.
Yeah. But we've been sitting at very low interest rates for a long time.
And we've been repeating that for at least, it feels like, forever.
Yeah.
Not forever, but it does. Now, this is just referencing, what particular sectors, how they've performed during time periods where the Fed has raised rates, and it's been a good time period over time for stocks, a majority of the time.
Right. It hasn't really negatively affected stocks most of the time. But we don't. A lot of times we approach discussions when we say the market. We're talking about stocks and equities,
right.
But we have a lot of people are invested in bonds, and bonds are good investments out there. But people are questioning whether, with an interest rate hike facing them, should I be in bonds?
Right. If you haven't looked at your portfolio, you really need to take a look, and we do this all the time, is long-term bonds.
Right.
Those out in maturities are going to be the most affected by an interest rate increase.
So how that works, kind of take a step back, is, when interest rates go up, bond yield
seesaw
change, and generally a bond that you're holding may go down in value when there's other bonds on the market with a higher rate.
Right.
It's a supply and demand thing. But as you can see, it doesn't always mean a negative effect on your bond portfolio. You can see here there were 3 rate hikes in 1999, and there's several cases like this. But there was U.S. bonds 3.5% return that year,
in
right?
17, yeah, in 2017.
In 2017, yeah.
And even it was a very slight downturn just overall to bonds
Right.
in 99. But there's been good years in 95, one rate increase, and it proved very beneficial, double-digit returns.
Right. So, I mean, makes the argument that bonds can still be a valuable part of a diversified portfolio.
Yeah, and that diversification is really the key.